The year is 2025. The stock market seems to be reaching new highs every day. Investors are riding a wave of optimism, pouring their savings into stocks. But what goes up must come down. A storm is brewing on the horizon, a stock market crash that could wipe out trillions of dollars in wealth. Many believe that this crash will be different, worse than those that came before. They point to the unprecedented levels of debt, the rise of risky investments, and the geopolitical instability that plagues our world. Ignoring these warning signs could be devastating, especially for those who are new to the stock market. This is not a time for complacency. This is a time for preparation. This guide will provide you with the knowledge and tools you need to not only survive the coming crash, but to thrive in its aftermath. Whether you're a seasoned investor or just starting out, understanding how to navigate a stock market crash is crucial for protecting your financial future. Don't wait until it's too late. The time to act is now. The stock market is a complex beast, driven by a multitude of factors. While predicting the exact timing of a crash is near impossible, there are often warning signs, cracks in the foundation that suggest a downturn is looming. Recognizing these indicators can be crucial for protecting your investments. One such indicator is market overvaluation. When stock prices rise at an unsustainable rate, far outpacing the actual growth of companies and the overall economy, it creates a bubble. This bubble is often fueled by speculation and hype, rather than solid fundamentals. Another red flag is rising interest rates. As interest rates increase, borrowing becomes more expensive for companies, potentially slowing down economic growth and impacting corporate profits. This can lead to a decline in stock prices. Geopolitical uncertainty and global events can also send shockwaves through the market. Trade wars, political instability, and unexpected crises can all trigger a loss of confidence among investors, leading to a sell-off in the stock market. By paying close attention to these and other economic indicators, investors can gain valuable insights into the health of the market and make more informed decisions about their portfolios. While every market crash is unique, they often follow a similar pattern, progressing through distinct stages. Understanding these stages can help investors better prepare for the emotional and financial roller coaster that a crash can bring. The first stage is often characterized by irrational exuberance and a sense of euphoria. Stock prices soar to new heights, driven by speculation and a belief that the good times will never end. This period of optimism can be dangerous as it can lead to complacency and overconfidence among investors. The second stage is marked by a trigger event, a catalyst that shatters the illusion of invincibility. This could be anything from an unexpected economic announcement to a geopolitical crisis. The trigger event often exposes underlying weaknesses in the market, leading to a loss of confidence and a shift in sentiment. As fear takes hold, the market enters the third stage, a sharp and rapid decline. Investors, panicked by the sudden downturn, scramble to sell their holdings, pushing prices down further. This downward spiral can be swift and brutal, wiping out significant value in a matter of days or even hours. Finally, as the dust settles, the market enters the fourth stage, a period of stabilization and potential recovery. This phase can be marked by volatility and uncertainty, as investors try to assess the damage and identify opportunities for growth. Not all investments are created equal, especially during a stock market crash. Understanding how different asset classes typically perform during a downturn is essential for building a resilient portfolio. Stocks, particularly those of growth companies, tend to be the most volatile during market crashes. They can experience swift and significant declines in value as investor sentiment sours. However, they also have the potential to rebound strongly during a recovery. Bonds, on the other hand, are generally considered less risky than stocks. They tend to hold their value better during market downturns, providing a stabilizing force in a diversified portfolio. However, their returns are also typically lower than those of stocks over the long term. Real estate, while less liquid than stocks or bonds, can provide a hedge against inflation and offer diversification benefits. However, real estate values can also decline during economic recessions. And it's important to remember that real estate is a local market. Commodities, such as gold and silver, are often seen as safe haven assets during times of economic uncertainty. Their prices tend to rise as investors seek to protect their capital. However, commodity prices can also be volatile, and their long-term performance can be unpredictable. Section 5. Preparing for the inevitable. Building a financial fortress. While predicting the exact timing of a stock market crash is impossible, there are steps you can take to prepare for the inevitable and protect your financial well-being. One of the most important steps is to build an emergency fund. This should be a separate savings account, containing enough money to cover 3 to 6 months of living expenses. Having this financial cushion can provide peace of mind and prevent you from having to sell investments at a loss during a market downturn. Another crucial step is to diversify your investment portfolio. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, such as stocks, bonds, real estate, and commodities. This diversification can help to mitigate losses and reduce the overall volatility of your portfolio. It's also wise to review your investment strategy and risk tolerance. If you're approaching retirement, you may want to consider shifting to a more conservative portfolio with a higher allocation to bonds and other fixed-income securities. If you're younger and have a longer time horizon, you may be able to tolerate more risk. Section 6. Mastering your emotions. The key to sound decision-making. Investing is as much about psychology as it is about numbers. During a market crash, it's easy to get caught up in the fear and panic. However, it's crucial to remember that emotional decision-making can be detrimental to your financial well-being. One of the biggest mistakes investors make during a downturn is panic selling. When the market is plummeting, it can be tempting to sell everything and cut your losses. However, this often leads to selling low and missing out on the eventual recovery. Instead of giving in to fear, try to focus on the long term. Remember that market crashes are a natural part of the economic cycle. While they can be painful in the short term, they also create opportunities for those who are prepared and disciplined. It's also important to stay informed, but don't obsess over every market fluctuation. Constantly checking your portfolio and watching the news can amplify your anxiety and lead to poor decision-making. Instead, focus on your long-term goals and tune out the noise. Section 7. Weathering the storm. Strategies for navigating a market downturn. When the market takes a nosedive, it can be tempting to bury your head in the sand and hope for the best. However, there are proactive steps you can take to protect your investments and even potentially profit from the downturn. One strategy is to rebalance your portfolio. As market conditions change, the asset allocation of your portfolio can drift from its target. Rebalancing involves selling some of your winners and buying more of your losers to bring your portfolio back into alignment with your risk tolerance and investment goals. Another strategy is to consider dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. By continuing to invest during a downturn, you can buy more shares when prices are lower, potentially lowering your average cost per share over the long term. If you have a long time horizon and a strong stomach for volatility, you may even consider opportunistically buying stocks that have been unfairly punished during the downturn. However, it's crucial to do your research and ensure that the companies you're investing in have solid fundamentals and are well positioned for a recovery. Section 8. Emerging stronger, seizing opportunities for recovery and growth. While market crashes can be unsettling, they also create opportunities for savvy investors to acquire assets at discounted prices and position themselves for long-term growth. As the market begins to stabilize and recover, it's important to stay informed and be ready to act. This may involve adjusting your investment strategy, rebalancing your portfolio, or taking advantage of tax loss harvesting opportunities. One strategy for capitalizing on market downturns is to focus on value investing. This involves identifying companies that are undervalued by the market, often due to short-term factors or negative sentiment. By investing in these companies when their prices are depressed, you can potentially achieve significant returns as they rebound. Another strategy is to look for opportunities in sectors that are poised for growth. After a market crash, certain industries may experience a surge in demand as the economy recovers. Identifying these sectors early on can give you a head start in capturing potential gains. Section 9. A prudent path forward. Embracing a long-term perspective. Navigating the stock market is a marathon, not a sprint. Market crashes are a natural part of the economic cycle, and it's essential to maintain a long-term perspective and not let short-term fluctuations derail your financial goals. By focusing on the fundamentals of sound investing, diversification, risk management, and emotional discipline, you can weather market storms and emerge stronger on the other side. Remember, the key to successful investing is not to predict the future, but to prepare for it. By taking a proactive and informed approach to managing your finances, you can navigate the ups and downs of the market with confidence and achieve your financial aspirations.